Welcome to the award-winning Moneymakers podcast. I'm Jonathan Davis, the founder and host. For more than 6 years now, we've been providing comment and discussion about all the latest developments in the world of investment trusts, the stock market listed funds often called the City of London's best-kept secret. I'm grateful to JP Morgan Asset Management for their continued no-strings support, which enables us to keep the podcast free while preserving our truly important independent editorial principles. Please note that while our comments are well-researched and our opinions honestly held, we do not offer individual stock recommendations. So this week on the podcast, it's my turn to have another conversation with Andrew McHattie, the editor of the Investment Trusts newsletter. It's obviously been quite a momentous week on the political front. We're recording this on a Thursday afternoon, and we learned today that Wes Streeting has resigned from the government and is about to launch a challenge to the Prime Minister. That's happening here, and meanwhile, over in China, President Trump is meeting with Mr. Xi, the Chinese ruler. Who knows what will come out of that, which may have implications for all of us. Possibly something to do with the Iran war may come out of that, but we don't know yet. So in response to that, well, the equity markets continue to be quite strong. The S&P is up over the last 5 trading days as we speak, around 2% or so. NASDAQ up even more. Those of you who listened to the Polar Capital Tech podcast last week will not be surprised to hear that the big tech shares are also still performing very well. NASDAQ up 3.5%. But over here, the gilts market has taken a bit of a hit, as you probably would expect, given the political news. On average, they're going down by between 0.5% and 1% across the spectrum, I'd say. And interesting enough, more than half the issues are now offering a gross redemption yield of more than 5%, which is a level that we haven't seen for some time. So against all that background, Andrew, it's a pleasure to come back to more specific things and talk about the investment trust sector, where, of course, there's always news to talk about every week, which is why we're able to keep going in the way we do. So where should we kick off? I think we might kick off with another proposed deal. Might be a good place to start. This one involves Picton Property, which I think it's a real estate investment trust, but the deal that we're talking about does involve another investment trust as well. So why don't you outline for us what's happened there, Andrew, and then we can talk about what it might mean.
Thanks, Jonathan. Yes, let's dig into this. The property sector has been shrinking with regard to investment trusts, and Picton is one of those that left a little while ago because it converted to become a self-managed company, which meant it's converted to REIT status. But it is now being taken out, or there's a proposal to do so anyway, through an all-share offer from London Metric and Schroders Real Estate Investment Trust. So this values Picton at 78.2 pence a share at a considerable discount to its asset value, but I think it's already received a fair amount of support and seems likely to go through. Now, this is interesting because effectively London Metric and the Schroder Investment Trust are going to carve up the portfolio and split it. It's about 46% to London Metric, 54% to Schroder Real Estate. And I think that might work quite well for the investment trust. So Schroder Real Estate stands to gain quite a bit of scale here. It should reduce its loan to value as regards its debt load. It has the potential to increase dividend income. It looks a pretty good deal all round. But as often happens when a company is using its paper, it's using its shares to make the offer, because this is an all-share offer, the shares have dipped in Schroder Real Estate. So maybe that's an opportunity.
I'm just looking at the numbers now, again, over the last 5 trading days, and obviously not since the date of the announcement. I can see London Metric's down about 1.8%, the Schroder Trust about the same, and Picton is down 5%. I think I saw some comment from brokers that some shareholders in Picton might be disappointed there wasn't a cash option in this deal. Obviously, it's always nice to get cash, unless you're sitting on a big capital gains tax liability, which is probably unlikely in this case, I would suggest. So this is just really continuing the general trend of consolidation in the commercial property sector. I mean, we've lost pretty much the bulk of the sector that we had, say, 2 years ago. So this doesn't come as a particular surprise, I would say. Do you have any particular views? I mean, there's not many that remain. We've got Schroder Real Estate Investment Trust, obviously the one that's involved in this deal. We've got Custodian, and we've got a couple of other smaller ones. But this really has been, if you like, almost the end of the commercial property sector, has it not? In the diversified commercial property sector, I should say.
Well, you're right. There's not too many left. And I did muse about this a while ago, maybe a year ago, really wondering whether any would be left at all, because it has been a shrinking sector. I think those that remain are probably amongst the strongest. It really is a case of last man standing. And we mustn't forget, actually, that we have TR Property, which invests in the shares of investment companies rather than investing in property directly in the main. And that's actually still going strong. That's a good trust with an excellent manager. And I think there's still one or two good trusts around. I think AEW has, of course, been an excellent trust. And I quite like Alternative Income REIT as well, which was nearly taken out by AEW, but that deal fell through. I do wonder whether somebody else might come in for that one. So maybe still one or two opportunities remaining, but certainly we have far less choice than we had a year or two ago.
I mean, the largest of the remainers, excluding TR Property, we've got Custodian with a market cap of around 380 million, Schroeder Real Estate 230, and AEW at 165. So, as you say, that will certainly bulk up the Schroeder Trust. They're all trading still on quite significant discounts, but with, well, a couple of exceptions. AEW has always been the most highly rated of them. At the moment, there's a lot of demand for yield across the investment trust sector. We see that in the regular issuance data. The yields are still relatively attractive. We're talking about 7%, that kind of thing across the four largest, I think, something of that order, which is not an unreasonable return, but I guess with gilts at 5% or something like that, the kind of premium you're getting is not that significant. What would you say about the yields on this particular universe?
I would agree with you that the yields are okay. I think they're not bad at this level, between 7 and 8% for something that may also give you some capital growth. But of course, as gilt yields rise, so they become more competitive and they are eating into the relative attraction here. But nevertheless, I think it's probably a decent idea to have some property in your portfolio. I wouldn't particularly go overweight at this point. But of course, should we see some resolution to the Iran war and eventually, therefore, some improvement in the outlook for UK interest rates, then that might help this sector.
Indeed, as I say, the discounts, they remain reasonably wide anyway, somewhere between, 10 and 20%, I think, in most cases, with the exception of AEW UK. Well, let's talk about another trust, something with a little bit of spice in it, and that is the latest announcements about SpaceX, this remarkable company that everyone is looking forward to the flotation of at some stage, probably this year, we're told. This is a company in which, as we discussed before, a number of Baillie Gifford trusts have significant holdings, as do a couple of private equity trusts. What has been the news this week, and what do you make of it?
So this week we heard from Scottish Mortgage Trust, which is still, I think, a bellwether for our sector. It's a £15.5 billion trust that many of us will own. And it, of course, does have a significant shareholding in SpaceX, which has been a wonderful holding for it. So it gave us a bit more colour on that this week with a pre-IPO note that it issued on SpaceX. So it confirmed that SpaceX is held at a $1.25 trillion valuation in the Scottish mortgage portfolio, which is interesting because we didn't know exactly what price it was held at. And that is below the $1.75 trillion price tag that's been put on SpaceX by speculation in the press. So it's good to see that Scottish Mortgage is holding it at a more conservative valuation. And we don't know yet what the price may be. It will depend on market conditions at the time of the IPO. Now, that IPO could come as soon as June, but we don't really know. Again, that will depend on market conditions. And we also don't know what lock-up restrictions will apply to the Scottish mortgage holding. So that may still be held at a discount to the market value. We'll see. So that was the immediate news, but I was also really struck actually by some further data that Scottish Mortgage shared with us about how much it invested in SpaceX. So it put the money in actually between 2018 and 2021. So it hasn't invested for the last 5 years, but it invested a total of £151 million. And on the current valuation, that's 2.98 billion. So if your maths is pretty quick, you'll see that's roughly a 20-fold increase in investment. This is why it's so meaningful. And I think it's a good reminder, actually, of the traditional virtues of investment trusts about long-term investment, about being patient and looking for those really big winners.
Yes, and this one really has the potential to be a really big winner. You might remind us of a couple of the other Baillie Gifford trusts that have stakes in this one as well, which might well lead us on to a discussion of one of them, which has been the subject of attack by Saba Capital. But perhaps you could just remind us of the others who have a stake in SpaceX.
Well, yes, Baillie Gifford have, of course, jumped into SpaceX with both feet, really. So there are 4 Baillie Gifford trusts that have really significant holdings here. So there's the Schiehallion Fund, there's Baillie Gifford US Growth, and then the one you were talking about there, Jonathan, Edinburgh Worldwide. They all have really quite significant holdings in SpaceX and have been benefiting very substantially from their holdings.
Indeed, and indeed, SpaceX holding in Edinburgh Worldwide has been one of the things that Mr. Weinstein, the founder of Saba Capital, has been banging on about, and he's been very critical of the board for having sold down its stake last year on the grounds of diversification. I mean, that's not something that's happened in the other Baillie Gifford trusts, I think it's fair to say. So this is going to be a big chunk of the value of all these trusts. And it's notable also that Scottish Mortgage has gone to a premium, trading at a premium, which hasn't done for quite a long time. So clearly investors are getting excited about the prospect of this particular flotation. At the same time, also reflecting some other holdings that they have, which are linked to the big surge in AI. Let's come back to Edinburgh Worldwide, though, shall we? But let's do so by means of diverting briefly to another Saba target, which is Herald, the one in which we've talked a lot about. That was one of the 7 trusts that Saba originally attacked by building up very significant stakes and trying to install their own directors and remove the existing ones. What's the latest news about Herald?
If we can cast our minds back, we'll remember that the board of Herald lost its vote on the tender offer, which was really to enable Saba to make a gracious exit close to NAV. And so it was due to implement a backstop tender offer, which was then to allow other shareholders to get out before Saba took control. But very wisely, actually, the Herald board did not initiate that straight away. They decided that it was worth trying to talk to Saba to try to reach some kind of agreement. And we've been waiting, actually, for several weeks to see exactly what's going to happen here. And now we know. So the good news is that an agreement has been reached, and I think this is quite sensible for all parties. So this avoids the implementation of that backstop tender offer. So what's going to happen is a 66% tender, which will include Saba, and they have agreed to exit by taking what's called an in specie option, which means they'll take shares in the companies that Herald holds, which means they're coming out at the full NAV without any costs. So that's a good exit for Saba. And the really good news is that Herald can then continue as an investment trust for those who would like to stay with it. But it's not going to continue in quite the same form because Aberdeen is going to take over as the management company in the 3rd quarter of the year, where Katie Potts and her existing team of 8 will be moving. So that's, I think, quite good news because we've rescued, effectively, Herald, which has many happy long-term investors. And I think maybe this is a rather better model here than that pursued by Edinburgh Worldwide and also Impact Environmental, where they did go ahead with their backstop tender offers and effectively Saba is taking control. So I think it's a decent outcome. But again, there's one thing that just bothers me slightly is that, well, we don't really know why Aberdeen are taking the management contract. And we don't really know what they've done to negotiate this quite impressive 3-year standstill agreement with Saba. So Saba's agreed not to interfere and not to vote against any proposals from the board here for 3 years. And actually, that same agreement can be applicable right across the Aberdeen Investment Trust range if the boards of each trust want to do that. So that's quite good news, I think, and a welcome change, a welcome shift in the tone of the negotiations here. But we don't really know what's happened behind closed doors.
No, we don't. Of course we don't. No doubt those details will begin to come out. But there's always a deal to be done, or at least that's always what we thought. There was always going to be a deal to be done. But I think one of the issues there has been that some boards have found it very difficult to deal with Saba because they're up against, if you like, a sharp individual who keeps his cards close to his chest most of the time and is harder to read, perhaps, so some other counterparties might be, and perhaps used to a different way of doing business. So, yes, it does seem to be like a not unreasonable outcome for Herald. I guess if this had been something that could have been achieved at the beginning, maybe the board of Herald would have taken it at that point, but we don't know what's been going on. But the Aberdeen angle is also interesting. Aberdeen obviously has lost one or two trusts over the last few years, and the possibility of having a 3-year standstill would be, I imagine, quite welcome to them. So if they felt that any of their remaining trusts were at risk, they'd have time. Hopefully the things will turn around. So that's an interesting outcome. In terms of the other targets where Saba had a very large stake, Impax Environmental Markets and Edinburgh Worldwide you've mentioned, what do you think, to the extent that they're still trading, the outcome for the discounts in these particular trusts? Do you have any views on that? I mean, Edinburgh Worldwide is trading around par, I think, more or less. Herald is on a 7% discount, something like that, which is narrower than it has been. And I think they're talking about trying to protect that. And Impax currently on a 10% discount.
Yes, I think it's quite difficult to call, actually. I rather suspect that these discounts are going to widen out again because I think maybe just there hasn't been very much more activity since most of the money has walked out of the door here in the tender offers. And those that are remaining are just sitting tight. And I think there's a fair bit of apathy or lack of impetus from those remaining, or they're Saba supporters who are happy to sit tight. Of course, what's going to happen now is that Saba will appoint its own directors or the directors it's proposed, and it's likely that the management contracts for these two trusts will move to Saba for it to change the mandate completely and start investing in UK investment trusts, just like their existing active ETF. So I think given the scale of the shift that's likely to happen, there could be some further upset in the shareholder register. Some people will exit, and so my feeling is that those discounts are probably at some risk of moving out.
In the past, we've noted that Saba's closed-end fund, the ETF that holds some of its stakes, has not been a great performer overall, but I have to say it's up around 10% year to date. So I think some of the fruits of its campaign are coming through. And we don't, of course, know how long it's going to be around, how long it's going to continue the strategy we think it's going to adopt, which is to continue to look for opportunities in the closed-end space and hound the boards it doesn't seem to like. So we'll have to wait and see. They haven't gone away, and they've certainly got more ammunition than they had before. So there's still perhaps a little bit too early to talk about whether their net effect on the investment trust sector has been positive or negative. I know opinions differ on that. I have a view, and I think you have a view. But it is interesting that these things are coming to a head. Let's move on then and talk about another trust which is also in Saba's eye line, and that is Pantheon International. Saba there has increased its stake in this large private equity trust, I think from around 5 to 10%, something like that. And of course, that has put the board of Pantheon on notice that there could be more challenges ahead at a time when they're already trying to counter the very wide persistent discount at which their shares trade. So what did we learn about that this week, and what do you make of it, Andrew?
Well, Saba is indeed in the frame here. One interesting thing about Saba's active ETF is that it's very, very transparent. So actually it releases its list of holdings on a daily basis, so you can see exactly what they're doing, and that's very interesting. So they have put more money into Pantheon, and Pantheon has another very vocal shareholder called HgCapital that's also written public letters and has been trying to persuade the board to do rather more to narrow the extremely wide discount here. And Pantheon has indeed been working on this. Of course, these things take time. And apparently Pantheon's been working on this particular deal for about 6 months. And it's announced it now. It's announced an asset sale of 42 of its secondary fund interests for about $300 million. So this is a significant sale, just over 10% of NAV. And Pantheon has managed to sell these assets at a headline discount of 8.1%, which sounds very good. It's actually not quite that good if you think about it a bit more deeply, because on current valuations, which are a little bit lower, it's probably more like a 13 to 15% discount. But it's still pretty good, actually. Certainly much narrower than the market discount, which is about 27%. So this highlights again, actually, the valuation gap between the private market for secondary fund interests and the public valuation of these private equity trusts. And Pantheon is going to use the majority of the proceeds here for share buybacks, which I think makes sense. And it says it's actually helping with its strategy as well, because it does want to concentrate its portfolio down to a smaller number of underlying fund managers. That was its plan anyway, and this just accelerates it. So I think overall this was a good move from Pantheon. It has served to narrow that discount a little bit, because across the private equity sector as a whole, I think the rather stodgy market conditions for realizations mean that it's still out of favour. And there's some very wide discounts, Jonathan. I'm looking at trusts like HgCapital on about a 39% discount, HgCapital, which has its own issues, on a 33% discount, Literacy Capital on 31%. There are a lot of wide discounts still here. So I think overall it's good to see Pantheon doing something about it.
Yes, I guess the issue will be, as with all the other Saba cases, whether or not the board has done enough to this point to prevent them being able to build up a larger stake. That, I guess, is an issue. We don't know the answer to that one yet. I mean, Pantheon was one of the first private equity trusts to try and deal with the discount issue almost 3 years ago now, I think, when they started laying out a capital allocation plan. And that certainly had an impact to start with. But then the discount started to widen again, and it's come back in again, as you say. But it's still fairly wide, right? Somewhere around 30%, something like that. And that is obviously a concern. Historically, it's traded much wider than that on occasions, but also more narrowly in other periods. So I think it's one to watch. As you say, the headline numbers of this particular transaction look good against the context of the private equity market. But I wonder if the market will continue to see some sort of imbalance in supply and demand in this particular share. It'll be interesting to see whether Saba is able to pick up more shares in this one at the current levels. And that, I think, will be quite an important outcome, particularly given, as you've already mentioned, the long time periods that it takes to get these deals done. And therefore, the boards of these trusts, they can't move that particularly quickly to counter this particular problem. So you mentioned HgCapital, Andrew, as being one of the private equity trusts that has seen its discount widen significantly. And now what is by that particular trust standards a very wide level, 30% plus. HgCapital has been a really good performer over many, many years, but investors seem to have been panicked, I think that's the word to use, into rethinking their attitude to the trust because of the potential impact of AI on software companies in particular. The idea that the more and more sophisticated models that AI developers are producing will be able to do an awful lot of coding and therefore take away some of the value that's embedded in software companies, which have been very, very popular and highly rated for a number of years. So what have you been able to deduce? HgCapital have produced some results, I think. Were you able to read anything into that about how successful they may be in trying to turn sentiment back around in their trust?
I could certainly get some idea of that, Jonathan, because actually when I started making my notes on this, HgCapital shares were 350 pence, and by the time I'd finished, they were 340. And I think that probably tells us everything we need to know about how these results were received. These were the first quarter results at the end of March. They showed the net asset value total return going down by 5.4%. Which is not that bad, but this was due to lower multiples across the sector. We know all about these software as a service companies being hit by all of these fears of AI competition. And my feeling is that HgCapital has put up a pretty articulate defense against this, explaining that it's in areas such as tax and accounting, payroll, legal, compliance, and insurance, where you really have to get everything 100% correct. And we know that AI models are not that great at hitting that 100% mark. So they put up their defense, but I think the market is still feeling quite negative here. And I think HgCapital Trust, their shares feel increasingly speculative, which seems a strange thing to say because for so many years this has been a great trust. It's been really well managed over a very long period. If you look at the 10-year returns, they're fantastic, 16.5% annualized returns over 10 years. And so my feeling is that the management here are of such a good quality that they will be able to manage this transition. This is not the first transition they've seen, and my sense is that they're probably right when they say that their companies are of the right quality to benefit from some of the integration of AI. But that doesn't overcome the short-term issues and the short-term worries and concerns. So for the moment, HgCapital shares are certainly out of favour. Hence that extremely wide discount of 33%, which for this particular trust is really an outlier. For many years, it was trading pretty close to its asset value.
And this does raise another issue, which has obviously been much discussed during the whole Saba campaign, which is the fact that investment trusts, we've always described them and recommended them on the basis of being sources of patient capital. In other words, that you can hold them for the long term and they will deliver good results over 5-10 years, those sort of things. And indeed, the historical record bears that out in several cases. But this period when we've seen very substantial discount widening and, more importantly, this remarkable volatility in discounts that we've seen in the case of HgCapital, it must begin to slightly erode one of the key selling points that investment trusts have always made, which is that, backers for the long term. And, okay, the discount may move up and down, but over time you'll see the rewards. But if you get this kind of volatility, which is very extreme, a 30% move effectively in just a few weeks and months, that's going to make selling that proposition to private investors during what's already a fairly volatile period rather harder, isn't it? And it does raise some, I think, worrying questions for the investment trust sector.
Well, that's an interesting perspective. I think there's a counter-argument here. So let me play devil's advocate. Let me give you the counter-argument to that, Jonathan, which is I think discounts are a self-balancing mechanism. And the discount is functioning well here exactly as it should to maintain a market here at a time when there is a lot of skepticism, when people are looking forward to the next NAV, which may be lower because there's a bit of a lag here in the downward movement. And you've got to maintain a level where there's a two-way market where people can buy. And my sense is that actually you're just being compensated here for the additional risk you're being asked to take on if you're thinking of buying this trust. Because honestly, with this outlook, would you want to buy HgCapital shares if they were trading at par or on a 5% discount? Well, the answer is probably no, because the risk seems quite high. But on a 33% discount, maybe you'd take a chance. If you're a long-term investor prepared to overlook, I think, this period of volatility and to look beyond it. So I think it's just the market working as it should.
Well, we'll see about how that plays out. I think my point is that to the extent that there is this structural mismatch in demand, supply and demand in the investment trust sector, maybe it's the fact that, as with HgCapital and other examples like that, where investors have come to sort of trust these instruments to go on churning out good results consistently over a period, and HgCapital has certainly been one of those. I think it does come a bit of a shock, and maybe it's taken time for people to wake up to the fact that the discount has widened significantly. Whatever they are doing, they don't seem to be buying at the margin. In other words, if there are enough investors out there who are confident that we'd hit the bottom in terms of discount, then you would surely see some buyers coming back. So you're right, the market will eventually correct this in one way or another. But I wonder whether the extent of the volatility is causing some significant problems in the shorter term. And it may be just, as we've often talked about, the natural buyers of investment trusts is a shrinking pool to some extent. We hope the pension funds are going to come back. They're now enabled to do so thanks to the amendment to the pensions investment bill that's just gone through. But it does need that extra demand to come through if the boards of these trusts don't do enough to try and reduce the discount in the meantime. I'm trying not to be negative. I do think that some of these trusts trading on very large discounts, particularly those which have unexpectedly suddenly become, 30% discount players like Oakley Capital and HgCapital, obviously I think they could well be bargains. But I do have a slight concern that it's still reflecting some more fundamental problems. We shall see. You are listening to the Moneymakers podcast. To keep up with every single item of news from the investment trust sector and all the latest share price, NAV and discount movements, why not try a subscription to the Moneymakers Circle, our premium content newsletter? You'll find there our in-depth independent profiles of more than 200 investment trusts and more commentary. Go to money-makers.co for more details. Do please like, subscribe and share through whatever platform you're using. As well as the usual podcast channels, we can also be found on YouTube, TikTok, X, Blue Sky, and most recently on Substack. Visit the website for more details. Let's move on to another story, which is not unrelated, a different part of the private equity landscape, if you like, and that is Chrysalis, a trust we've talked about a number of times. This is a trust that mostly invests in relatively early stage unquoted companies. They have been on a roller coaster ride, we keep on using that phrase, and there's been some quite interesting news coming out of them over the last couple of years. But tell us what the latest is on this particular trust, where we already knew that the board had decided to get rid of the existing managers, but what have they said now?
You've needed a strong stomach to be an investor in this one, because it really has been a roller coaster, yes. And we've seen that continuing, because the trust's end of March net asset value came out at 137.3 pence, which was down by 17%, which sounds like a really swinging decrease. It sounds awful, actually, but there is an explanation, I think, and it's maybe not quite as bad as it first sounds. So let's deal with that. First of all, this was the end of March, when listed markets were really down on the first news of the Iran war. And of course, they have recovered very significantly since that time. So we may see a bit of a V-shape here in what happens to the NAV. I think as well, we can say that the shares are already discounting quite a lot of this volatility, with a very wide discount of about 42%. And it was encouraging as well that the trust said the performance from its underlying companies remained strong. So there are companies, some of which we'll know, like Starling Bank and WeFox. And one intriguing one is Klarna, where the trust had high hopes, actually, for the shares after its American IPO, which proved to be pretty awful, and the shares really plummeted after the IPO. So let's hope there's no read across there for SpaceX. And until today, actually, I was going to say that Klarna shares were still on their knees. But actually, Klarna's first quarter earnings really beat expectations quite considerably. So as we're talking, Jonathan, I think the shares are up 14% today in Klarna. So that's slightly better. So I think overall it sounds awful for Chrysalis. It's maybe not quite as bad as that headline figure suggests, but there are changes afoot, because it is going ahead and switching to a self-managed model in August. So it's effectively sacked the managers here, and it's bringing the management in-house for the wind down process, which is likely to be quite slow. It may take a number of years to sell out of these companies at the right moments. So my feeling is that Chrysalis is going to be a colourful member of our sector for a while yet, and there's probably a fair bit more of stomach-churning volatility to come.
Yes, indeed. It has been an extraordinary story, really, from the very beginning. And not least, I think investor sentiment has been badly coloured by the, if you like, I would call it scandalous performance fee saga that accompanied this particular trust. The terms of the performance fee were so grossly inadequate to protect shareholders' interests that the managers are able to take out a huge performance fee almost to the day that the share price went into almost terminal decline. So I think that's always coloured sentiment. Their shares trade at a discount still of over 40%. As you say, maybe the factors you mentioned will help in the short term, maybe not. But if we look at Augmentum Fintech, another trust that invests in earlier stage companies anyway, that is disappearing, and basically there's a sort of 30% haircut, if you like, against the NAV there. If they go through the self-managed process, there will be people, I guess, who will hang on and hope that they'll be able to do better than expected. But, investors are not going to see the NAV ever again, are they, at this point?
I don't think they are. And actually, the experience of late has been that wind downs have not been progressing that well for trusts that are known to be distressed sellers in the market. So if you're a potential buyer for Starling or for WeFox or for any other of the Chrysalis holdings, you know that you can probably demand a very good price. So I don't think the wind is behind shareholders here. But who knows? It could be that Starling Bank actually is able to IPO at a very good price. There could be ways of extracting actually quite a lot more value than is currently implied by the share price. But I do think that you can't take it as read at all that there are going to be any uplifts here. So you'd have to say that it's a speculative position at this point.
What is striking, if you look across the whole spectrum of private equity, and perhaps it is a bit unfair to compare since these vehicles are not like for like, but if you look at the year-to-date performance, I mean, it is quite extraordinary, the disparity in returns. Seraphim Space is up by around 96%. Schiehallion, which is also in the early stage business but has the SpaceX investment, is up 42%. Augmentum FinTech is up around 20% on the back of their exit. Molten Ventures is also doing well, up 18%. And then down towards the bottom, you've got some of the bigger names. HgCapital, we mentioned, 32%. Partners Group, 21%. Down, in the share price down. Literacy Capital down 17%. Oakley Capital, 15%, and so on. So it's very much as if, if you're going to be doing well at the moment in this particular space, you want to be in the specialist areas that still have some growth in them, because the overall performance has been pretty dire. And that's despite the fact that many people have been saying for a couple of years that they think the discounts look attractive at the levels they are. Maybe the market has a different view, or we can say perhaps. That's a polite way of putting it. And let's move on then and talk about another case which is not going particularly well. I'm sorry we seem to have a lot of negative news this week, but let's talk about Aquila European Renewables, ticker AERI. This is obviously one of a number of renewable energy trusts which has been struggling, share price performing poorly, but a board there has been attempting to complete the sale of its assets, get rid of it and wind it down. But things are not going quite according to plan, are they?
They're not going according to plan at all. No, so its deal to sell half of its portfolio to the managers or the investment advisors, HgCapital, has fallen through. Apparently because HgCapital decided to enter late renegotiations, let's say, to put it politely, where they wanted to reduce the price quite significantly. And there has been a breakdown of relations here, I think. The chairman of the investment trust, Robert Naylor, says the board is deeply troubled by the conduct of HgCapital. So it's not just that this deal has fallen through, but it's really that the board has now also fallen out with its investment advisor. So I'm not sure quite where the trust goes from here. The likelihood is we'll have a bit more news. And in the meantime, of course, the shares have taken this badly and gone down by about 10% in one go today. So I'm not sure where that leaves this trust. And it's a great shame, actually. Again, it's another example of wind downs not currently progressing as cleanly as everybody would like. And I think this has changed because actually probably 3 or 4 years ago, I think there was always a good opportunity when a trust was winding down to be patient and to sit tight and wait for it to complete and extract value. But I think for many shareholders, the exact reverse is now true, that perhaps when a trust announces it's going to wind down, the best strategy is to get out straight away, because very often more value seems to be destroyed and more deals fall by the wayside.
Yeah, I'm afraid that has certainly been the case in quite a lot of cases recently. And that also, of course, speaks to the issue of trying to exit things in a period of poor liquidity. It's not easy to do that. So I don't know where this one goes. The share price has, as you said, taken a dive. And again, it looks likely that even if the board can regroup and find some other sellers, or even if they eventually have to deal with Aquila on different terms, again, if you're hoping for a significant reversal of your recent experience as a shareholder, you're probably not likely to get it. You might get an improvement, but you're not necessarily going to be making a gain that you were hoping for. And this also, it has to be said, has some implications for another trust that we've talked about in the past, which is Achilles Investment Trust. This is the trust of which Robert Naylor, who is involved in this particular case, is also the lead manager there. That came to the market promising to adopt an activist style towards some renewable and other alternative investment trusts. And so this has really been a bit of a knockback for them as well, has it not? For those investors who actually follow this one, I'm not sure that many do. It's been quite difficult to get a quote for this one. Do you have any thoughts about that? I mean, it's a shame if it is true, because the Naylor-Harwood Capital combination did a good job with Hypnosis and also with a couple of other trusts. So this has been a disappointment for them, I think.
Yes, it's been a very mixed week for Achilles Investment Company, and I think that probably caps a fairly mixed year, actually. So I have been a bit disappointed with this trust. It did come to the market at a very difficult time. It managed to attract enough capital to float. It was really the last IPO we had in the traditional investment company sector. And I think many investors expected that combination to really extract good value from this market. And so far, they haven't done so. The NAV really hasn't moved very much at all. And this week, I think, typified it because, on the one hand, they had a very good outcome with their holding in Spire Healthcare, which did attract an offer, and the shares went up by, I think, 47%. But that was rather balanced by the news on Aquila European. So good news, bad news there. And I think that's really been how it's played out for this trust since inception so far.
Yeah, so I mean, the shares are still trading not far from 100p, their issue price, but they're not doing as well as they clearly hoped, and those who backed them clearly hoped. But we'll have to see how this plays out. I mean, just slightly unorthodox. I mean, I can't remember many examples where a potential buyer of assets has turned around at the last minute and said they want a significantly different price. It has happened in one or two cases, and the board will try and get a better price, I'm sure, from somebody else. But of course, Aquila are the people who actually know the assets very well and know the sector. So it will be a challenge, I think, that's fair to say. So while we're on the subject of renewables, we might also mention what's been going on with Bluefield Solar, one of the solar trusts, which has already announced that it's looking to sell its assets and liquidate. But we're still waiting for news on that. But they put out some latest NAV figures this week, I think, Andrew.
Yes, that's right, Jonathan. We had the latest quarterly figures from Bluefield Solar Income showing that the NAV to the end of March was down by 3%, which I don't think is a surprise because we've seen NAVs drifting off generally in the renewable sector, mainly due to weaker power prices. And also, let's not forget the government's tinkering with all of the various metrics, which haven't helped. So not a surprise there, and I don't think anything to worry about. The main issue I think we're really looking at with Bluefield Solar Income is just when we're going to get some news on a purchase price, because this trust is up for sale, it's being marketed, and I do feel that we're going to get some offers in. It's a high quality trust, I think, this one, with some very, very good assets that I think should appeal to buyers across the sector. We don't know what the purchase price is going to be. And that, I think, is going to be really important, not just for shareholders in this trust, but I think as a read across to some of the rest of the sector as well.
Indeed it is. And we know that it's trading on a discount of around 27, 28% Bluefield Solar. Obviously, the market will be hoping that any sale that is achieved will be obviously at a higher price than the one implied by that discount. And that has come in to a level where it's now only, I think, behind Greencoat UK Wind and Greencoat Renewables in terms of discount, and they're on around 23, 24%. So as you say, there will be a read across to other trusts, plus, of course, the fact that they are already well advanced in this sale process, while the others are not in most cases. We've heard about Aquila European Renewables, of course, but others not at the same price. So there will be, if you like, a discount for the time value of money involved. So you would expect anybody whose sale is imminent, provided the price is decent, to trade on a slightly narrower discount than the others. Well, we'll have to hope. It's been a long time now that we've seen the renewables drift lower, as you say. NAVs have come down, but the discounts have remained wide. So I think everybody is watching this one very closely, and we'll have to wait and see what happens there. So what's left to talk about this week, Andrew? Well, a couple of things. One trust which has taken one or two investors by surprise is a Foreign and Colonial Investment Trust, where I think it highlights a particular issue that perhaps relatively inexperienced private investors do run up against occasionally. And perhaps you can explain why some investors have been alarmed to see that the share price of their trust has gone down by 75%. What can you say to reassure anyone who's in that position?
Well, I'm very glad to say I can reassure shareholders here. We've been talking about other shares being in trouble, but that's not the case for F&C Investment Trust, because the shares have gone through a 4-for-1 share split. So yes, the share price has gone down to a quarter of its former level, but you have 4 times as many shares. So you have the same economic interest that you had before. And trusts do this from time to time when their share prices grow to unwieldy levels. It helps with liquidity, it helps with regular saving, it just makes it much easier to deal. And actually, I think that foreign and colonial, sorry, that's me being old-fashioned there, F&C Investment Trust is still doing well. Its NAV is up 22.8% over 1 year, which is not far behind Scottish Mortgage. So I think it's a good participant in the global sector, and it has holdings in Nvidia, Apple, Alphabet, Microsoft. So it's certainly playing its part in supporting the American technology sector. But one thing I noted, which I think is really interesting, somebody told me about a recommendation from Martin Lewis this week, which was for an iShares global tracker, which he said was a good idea for beginner investors. And I don't think he's wrong, but one thing I think is relevant to point out is that if you're buying a global equity tracker, you're buying something that has more than 70% of its assets in the US. So it's almost a US plus fund. And I think given the elevated valuations in America and the potential for a bit more political uncertainty given their leadership, my preference is to have a rather lower percentage in North America, and F&C fits that bill because its North American equity exposure is 55%, which I think is a little more comfortable. So for me, it's a sound choice, and certainly this share split doesn't do it any harm.
I think that's a very good point to make. Obviously, the US market has bounced back again, having underperformed other parts of the world for a while. And you make some very good points about F&C as a long-term savings vehicle. It has traded at a narrower discount than it is at the moment in the past, but it's doing okay. So I'm just looking through the list of best performing trusts over the past year. I mean, you mentioned foreign and colonial in that context. And it is remarkable how well you've done if you'd actually taken the view, which many commentators did at the start of last year, that you should veer a little bit away from the US towards other parts of the world, particularly Asia and emerging markets. And looking down this list, I mean, that has been a very sensible suggestion, because I can see we're looking here at some of these Fidelity emerging markets as share prices doubled in the past year. We've got Pacific Horizon, a well-known Asian trust. We've got Templeton Emerging Markets, that's been up around 80%. Aberdeen Asian Income, 60%, and so on. Schroeder Asia Pacific up 53%. That general thought about rebalancing your portfolio away from the US has been the right call over the last 18 months or so. And of course, we don't know what the future will hold, but notwithstanding the Iran war and the impact that has on energy importing countries, it still seems to me it's a pretty reasonable stance to take, given the concentration that is very high by historic levels of the US market in the world index. It would be difficult to disagree with you on that particular issue, Andrew. Difficult to disagree with you on many issues, but there we are. So that brings us to the end of this recording. Thank you, Andrew, as always, for your thoughts on these various developments. I'm sorry there has been a negative skew to what we've been talking about, but the underlying position of the investment trust sector is actually a lot better than this particular collection of names might suggest, is it not? I mean, we have seen some evidence now that the discount has come in, or is steadied around 10, 11, 12%. And we're seeing evidence that investment trusts are once again delivering on their promise of producing superior returns to open-ended equivalents. Perhaps you could just wrap up by talking about that for a second.
Yes, absolutely. I wouldn't want to finish on a negative note at all. And I would just point out just one other small item, which is that Seraphim Space has managed to raise some fresh money, including £45 million from retail shareholders. So I think that's a bit of good news. But generally, yes, the other element of good news I think I'd like to talk about is just the relative performance of investment trusts against their open-ended counterparts. And it's always quite difficult to compare the two. But of course, there are a certain number of investment trusts that do have really very comparable sister funds that are managed by the same team with the same mandate, the same strategy, but they just use this different format. And the Association of Investment Companies has very helpfully compiled some data to compare investment trusts with those sister funds. And over a 10-year period, it's found that 77% of the investment trusts have outperformed their open-ended counterparts. And I think that's a wonderful piece of news for the sector. And it's not a surprise, of course. We've known for a long time that investment trusts have consistently had an edge over the open-ended structure. And some of that is due to their ability to gear. Some of that is the flexibility to hold less liquid instruments. Some of it is down to the independent boards. And I think we really do need to celebrate that structure, especially when it's creaking a little bit now from the stress of the attacks from Saba and I think the wide discounts that we've been struggling with.
Yes, indeed. I mean, of course, you can always prove anything with numbers by picking the right start date, but I think it's fair to say that obviously the sector has shrunk and we've lost quite a few of the less well-performing investment trusts. But the ones that remain, including the ones that are what I would call the cream of the crop, they continue to do exactly what you say. And that is, I think, a tribute to the qualities and the benefits of the structure itself, which do bear out over time. But we do have to emphasize it is over time rather than necessarily every year that happens. On that note, I should also mention, I noted from the latest monthly review of Winterflood Securities that April was the best month for investment trust performance since April 2020, which was the bounce back month after COVID panic sell-off, and has outperformed the FTSE All-Share Index by its largest margin since 2003. So that's just a one-month figure, which of course proves nothing, but I think it's just symptomatic of the fact that those investment trusts that have survived the cull of the last 3 years will continue to offer considerable potential for patient long-term investors. So that's it this week. Next week, we will be hearing from Evie Hambro, the manager of BlackRock World Mining, which is another trust that has delivered 100% share price performance over the last 12 months, which again is a fairly remarkable figure. He'll be talking about all the issues that are working in favour of commodities at the moment, in particular gold and copper.
Thank you for listening to the Moneymakers Investment Trust podcast, sponsored by JP Morgan Asset Management and independently produced and edited by Moneymakers. If you like what you have heard, do tell your friends and colleagues, and remember to subscribe through your favourite podcast app or at the website so you never miss an episode, and follow us on our social media channels. For more news, commentary and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription. All details are at the website money-makers.co. Podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice.